Hello, chart watchers, and happy Valentine's Day. Welcome to this Thursday, February 14th, 2019 Market Watchers live show with your hosts, Tom Bowley and Bill Shelby. Aaron is out today for a personal matter, but will be back with me next week. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Let's take a look at what's going on in the market. Well, we had a little bit of a shock early, but the market is bouncing back off of it. We'll talk about the shock in just a second. But the Dow Jones Industrial Average currently down 107 points. The S&P 500 down 7 2/3. The NASDAQ actually has climbed back up into positive territory, up 3. And the Russell 2000 continues to perform really well on a relative basis, up 4 points today. 10-year Treasury yield down about 4 basis points now, 2.66%. Volatility took a jump earlier in the day, but has pulled back quite a bit off of that earlier high. Leading to the upside today, we've got communication services, one of our aggressive groups. Did gap down like the overall market, but has worked its way back into positive territory. That's helping to lead the NASDAQ. Energy also having a strong day, trying to make a breakout above that early February high. That would be bullish for the XLE. Financials lagging to the downside. Not shocking, though, when you see the 10-year Treasury yield down more than 4 basis points. In individual stocks, Marathon Oil leading to the upside, up nearly 9% today. Strong earnings there. Cisco also not just strong earnings, but also a strong outlook. Gapped up, but it is off of its earlier high. Still, the uptrend remains in play for Cisco. But on the flip side, and there's always a flip side, International Flavors did miss and lowered their guidance going forward. Stock getting hit very hard, the worst performer in the S&P 500 today. All right, Bill Shelby, I tell you what, this takes me back a little ways. Bill and I, for those of you that don't know, we used to do our show together back when, just before StockCharts TV, when we were doing webinars, and Bill was really helped me with my show for a while. It's always great to have you back, and I'm going to get you for the whole show today. I upgraded you. How's that, Bill?
I got the free upgrade. It rarely happens.
I know you're happy when I asked you to upgrade from guest to co-host.
Yes, exactly. I didn't have anything else planned for this morning anyway, so always happy to stop in.
Yeah, that's a good thing because it really wasn't an invitation. I was going to really try to get you to do it anyway. So, but I think everybody out there is going to benefit because for those of you who don't know, Bill is really the brains behind a lot of what's going on, especially with the scan engine and so forth. So we're going to have quite a guest / co-host with us today. Look forward to having Bill hang out. What do you think of the market, by the way? I mean, we had the huge drop back in the fourth quarter. Now we've had this huge rally back. I mean, what do you make of it?
I'm kind of surprised that we've come back this hard. I know there was some questions about, the shutdown and is this going to go on, and the whole China trade thing is still kind of hanging out there, and what's the Fed going to do? I was expecting a lot choppier movement, and I was expecting that we would be sort of hanging around those lows that we hit, maybe not quite those Christmas Eve lows, but I'm quite surprised that we bounced back this far, and I'm a little suspicious. You see Europe not performing that well, Italy in a recession. Technically, I think in Germany is close, if not there. So there's some signs outside the U.S. that things are not great. So cautiously optimistic, I would guess I'd say.
Yeah, I kind of share your sentiment. I mean, I'm surprised the rally has been so fast and furious back to the upside. I mean, we are back on the S&P 500 now, 2750 area. We're not far from 2800, not too far from an all-time high. It's almost like, that fourth quarter was a blur in a rearview mirror. Now, whether or not we go back down, I'm beginning to doubt that. But I'm going to have to see some technical signs of some weakness ahead. But anyhow, we're going to be talking about a lot of things. Let's go ahead and jump into the upcoming schedule and our agenda for the day. One reminder, Monday, no live shows. It is President's Day. The market will be closed. And so as a result, we will not be having a show. Tuesday, we've got Aaron's workshop. Looking forward to that. And then next Thursday, Julius DeKempenaar is going to join. And I tell you, I was having a chat with Julius. And for those of you who've been listening to Market Watchers Live last couple of weeks when I've done that break it down segment with, I looked at consumer discretionary, and I looked at industrials, and I used a lot of different tools at StockCharts to break down those two industry groups. And one of the areas was the RRG analysis. And I talked to Julius about it, and he was really excited. So just going to throw out the, maybe a little carrot here, but I think Julius and I are going to break down technology when he comes on. Of course, with his expertise with the RRG, I think it'll be fascinating. Today's agenda, we've got popular oscillators. Everybody who likes to follow momentum here at StockCharts, Bill is with me today, and he is going to walk you through the popular oscillators here at StockCharts.com. So looking forward to that. 10 in 10 as usual, 10 till 1. We're going to get started. Generac, GNRC, will be the first symbol. So take a look at that symbol, see what you think, and see if you agree or disagree with me when I go over that chart with you. And then the last segment, we're going to do a new segment. Bill and I are going to do a little chart chatter. And the whole idea there is that the technicals kind of speak to us before the fundamentals. So we're going to talk a little bit about some stocks that have had some good runs, maybe not so good runs, and take a look at what the technicals were saying prior to some news coming out. So I think that'll be an interesting segment as well. But let's go ahead and get started. We do have the economic news out today, a bunch of economic news out today. Honestly, I mean, it was crazy. Initial jobless claims, you can see, first of all, higher than expected. So that was not very good news. But the real bomb came with the retail sales. You can see January PPI and core PPI. The PPI was a little bit less than expected. Core was slightly above. But December retail sales, minus 1.2%. The market was looking for 0.1% rise. I'm not shocked by the number, to be honest. And I think the way the market's trading, I don't think the market was shocked. And we're going to take a look at an XRT chart, which is it's a widely diversified ETF that tracks a number. I think there's like 130 or 140 retail stocks in that ETF. Very widely diversified. We'll talk about that a little bit, how it's been trading. But you can see the numbers. Fundamentally, the retail sales were not good in December. Strip out the autos, they were even worse, minus 1.8% versus a flat expectation. And then finally at 10 a.m., we had November business inventories. They also came in weaker than expected, dropping 0.1% versus the rise of 0.2 that was expected. Now let's take a look and get the latest on the 10-year Treasury yield. All right, here you can see we moved back up above that 20-day moving average barely yesterday and then right back down today. However, we are moving off the low. I'm going to be interested to see if with this horrible retail sales number, which obviously drove a lot of folks into bonds today, sending the yields down, it's going to be interesting to see if it flips and we get a big reversal with a horrible economic report. I think that would be a pretty good sign, a bullish sign in the yield, and potentially a bullish sign for the equity markets if we do get that reversal. Still a lot of work to do, though, here on this particular chart. Earnings. All right, bunch of earnings coming out. The big one, I would say the 800-pound gorilla in the room, but that's Amazon and Apple. They're the $800 billion market cap company. So Cisco is only $200 billion, so I guess they're the 200-pound elephant. But still pretty big. 73 cents versus 72. They beat on their top line, beat on their bottom line, and raised their revenue guidance going forward. We'll look at that chart in just a moment. AIG, really not a good report there. Williams Companies, not good there. Network Appliance beat, but they did lower their guidance going forward. And so not a great reaction there. Coca-Cola was getting hit pretty good earlier after they just matched expectations, also lowering guidance. And then you can see those last two, AstraZeneca and Waste Management, beating earnings expectations. After the bell, it's not slowing down. NVIDIA, Applied Materials, two huge semiconductor companies that really underperformed in the fourth quarter. Applied Materials in particular has begun to strengthen. NVIDIA, not quite as much. But these are going to be two big reports to see. NVIDIA already warned. So this could be one of those situations like we had with Apple, where the company warns, takes the hit, which NVIDIA did, and then they come out. Maybe they beat a little bit. I mean, if company management's smart, they would have probably thrown all their dirty laundry in when they warned so that they can come out now with at least maybe a little bit better than expected number, but we'll see. Anyhow, some pretty big companies reporting after the close. Also, I wanted to just mention that last company, their XPO. Remember, that was the one that the shorts had a field day with a month or two ago when a hedge fund came out and suggested that the management of XPO, in particular, I think it was the president or CEO, could be doing things fraudulently, that was making some accusations at a previous position that he had. But anyway, the XPO got hit really hard, bounced back. We'll see what happens with their earnings after the bell tonight. Okay, lots to talk about. So let's first go in, and I'm going to go through some of these earnings reports, and we'll pull up the charts. But I wanted to show you the retail chart, the XRT, relative to the S&P 500. And when we talk later, Bill and I will talk a little bit about chart chatter and the fact that the technicals are basically talking to us. That's what technical analysis is all about. It's about reading the chart and allowing the charts to tell us what's going on in the market rather than waiting for the fundamental news to come out. And if you look at the performance of the XRT, which was horrific in the second half of the year, especially in the fourth quarter, we shouldn't be surprised by a fundamental report that comes out in December showing that retail sales were much lower than expected. Look at how the XRT was performing. We had a double top in back in August. And you could, depending on where you want to draw your lines, I mean, clearly there was an uptrend that was broken sometime in September, or maybe if you want to say into October, whatever, but it definitely, there was an uptrend broken. And through the last 4 months of 2018, the retail stocks were losing ground in a big way to the S&P 500. So even though the S&P 500 fell in the fourth quarter, the XRT, what this is telling us, the XRT was falling even faster. So money was rotating out of that group. And clearly the market was telling us, the chart was telling us that it was not good. It was not a good picture for retail stocks. Now here we are in February getting the December news that, oh, by the way, retail sales were horrible in December. Well, the market already told us that. So what I'm really interested in is how the XRT performs now, knowing that that bad news is out there. And I'm going to go over here. I want to get a candlestick chart. So look at the gap down today with the news, and look at what the XRT is doing. I know you've heard that old Wall Street adage, buy on rumor, sell on news. Well, it also applies to sell on rumor and buy on news. And so we had a lot of the XRT, the sell-off taking place back ahead of the news that just came out this morning. Now with the news, we're seeing buyers stepping in and supporting the group, and we're trading above the 20-day moving average. Now, the reason I think this is important is I'm awaiting a breakout in the XLY on a relative basis versus the S&P 500, and the XRT is obviously a very big component of discretionary stocks. Retail is a huge part of consumer discretionary. So as we take a look, and I'm going to go back now to that line chart, and let me pull up the XRT, first of all, relative to the S&P. So I'm going to go back and show you that chart we were just looking at, and you can see the downtrend. But if we can begin to strengthen, and one of the things I want to look for is a sustained move above that 20 period moving average, or in this case, 20-day moving average. But also let's look at the XRT versus the XLY. So this is just looking at discretionary and how retail has been performing. We just broke to a multi-year low the way we've been trading. So if we can strengthen technically on the XRT, and especially if we could begin to break out, if more than the fair share of money going into discretionary began finding its way into retail stocks, I think that could go a long way toward helping the market. So let's take a look at the XLY versus the S&P 500. So now how is consumer discretionary doing relative to the S&P? Well, despite all of that weakness in retail, look at what we did to start the year. The XLY was actually breaking out relative to the S&P 500 with a horrid retail group. So if the retail group, if the bottom is in, and it's kind of looking like that with such a horrible fundamental report and the group bouncing back, if retail can begin to break out and start to strengthen, then I think we're looking at a breakout in this XLY SPX, which I believe would be very bullish, because if we go back, and I'm going to pull this up on a weekly basis and look at the XLY versus the S&P 500, I've shown this before, but when you break out of these consolidations, like we did back at the beginning of 2015, look at the outperformance there. And then we had almost a 2-year consolidation period, which we broke out of in the first half of 2018. And now we're doing a little bit more sideways consolidation. I'm expecting a breakout. I think consumer discretionary is going to lead later in 2019. And the XRT, if we could get that, start to see the strengthening technicals there, I think that could help lead to that. All right, let's take a look at some of the charts the companies came out with earnings. Here's Cisco. Now, it is off of its earlier high, but I love the chart. I like this sideways consolidation breaking out with the news. Yeah, we could pull back, and if we get some sort of reversing candle, if we come back to 48, chances are maybe we'll go back to test that rising 20-day moving average. I don't think we'll close below it, though. I think Cisco did come out with a really nice report today. As I mentioned earlier, they beat on their top line, $12.45 billion in revenue. Market was looking for 12.43. They beat on their bottom line, 73 cents versus 72. And then they guided their Q3 revenues higher. They raised their quarterly dividend 6%, and they approved an additional $15 billion increase to their buyback. And you think $15 billion, and maybe that's not a whole lot. Well, it's a $200 billion company, 7.5%. Well, I think it's actually over 200 billion. So maybe it's, I don't know, maybe it's 6%, 7%, something like that. That's a pretty good number to add to an existing buyback. So I think there's a lot of positives here with Cisco. And by the way, when you look at the telecommunications group, we haven't broken out yet, but Cisco has. So what you have is one of the stronger stocks within this group. And you can see it's performing well versus the S&P, and its peers are performing well versus the S&P. I like Cisco. I think this is a staple in a portfolio as we head into 2019, or throughout 2019, I should say. AIG. Actually, let's keep the relative chart here. All right, American International Group, AIG. And you can see that the stock did react negatively. They had a horrible bottom line. And I don't even know if this number is comparable or not. I couldn't. I did some research, tried to find to see if maybe it wasn't comparable. But they had a loss of 63 cents. And I'm showing consensus estimates of a gain or profit of 47 cents. That's one of the biggest misses I've seen. And you can see the stock getting hit pretty hard today. But with that kind of miss, I would have thought even more than 6% to the downside. So I don't know if those numbers were comparable. But nonetheless, not a good reaction. Stock not looking very good. WMB, which is Williams Companies, they also had a bad report. Missed on the bottom line, 19 cents versus 22. But the stock's still holding up. So with the news and bad news, the stock only down 1% or so. And you can see the overall group beginning to strengthen. This is in the pipeline area. And so the stock, even though it's not one of the better performers, with bad news, holds up technically. So if it loses, say, $26, I'd be a little careful with WMB. Otherwise, this one looks like it's trying to carve out a bottom. Network Appliance, big miss on their top line. $1.56 billion versus $1.60. And bottom line, as I showed earlier, $1.20 versus $1.15. But the big problem was they guided their Q4 revenues lower. So gap down, so far rallying back up. I don't like this. If we can climb back up above the 20-day moving average, then I give it a reasonable chance to resume its recent uptrend. But until we see that, I'd be careful with Network Appliance. Coca-Cola. Guided fiscal year 19 earnings per share lower. Now, this is a big level because as you can see on the chart, you got highs, reaction lows, high, double top, and here is a reaction low. If we fail to hold that, it looks to me like we go back to test the double bottom that's below $44. So I think we need to hold 45.75, 45.80, or I think Coca-Cola's probably got another 4 or 5% in it to the downside. And this is a company, when you look back over the last year, it's only got about a $10 range, 40 to 50. So this has not been a big mover, and yet the stock down almost $4 today. That's a huge move down when you consider the overall move that we've seen in this stock throughout the year. All right, just one or two more quick, and then we're going to let Bill take it over. AstraZeneca, you can see AZN was in a downtrend, not reacting, not performing very well, but the stock did come out and beat on their top line, $6.42 billion versus $6.33 billion, and they crushed the bottom line. $1.58 versus 73 cents. Again, not sure if that's comparable or not, but that's what Zacks is showing. And you can see a nice reaction here, up 9% on AstraZeneca and breaking above that recent high. So looking pretty good here. If it does continue to strengthen, I would use the top of gap support, which is now at 39, as a key area for potential entry down the road. Last one is WM, which is Waste Management. They beat on the top line. And the one thing I wanted to point out here is look at the group. The group was breaking out. So when you look down here, and I mentioned when I went over the break it down segment and industrials, if you caught that, this is one of the areas I talked about that I think is still very strong. So with the group continuing to perform well versus the S&P, waste management performing well versus the S&P, and then with the continuing move to the upside with solid earnings, I think waste management's another staple in 2019. I think this is a nice looking stock that's in a great looking area of the market. All right, I know everybody is waiting with bated breath, Bill, for your presentation on your various momentum oscillators, so I'm going to let you take it away. What do you got for us?
All right, let me just switch over to screens here. We did the poll yesterday and had a number of different things that we thought we could chat about, but the oscillators seem to be the leader, so we're going to go with that. There are a number of oscillators that we've got for measuring momentum on the site, and they're broken into a couple of different flavors. So we're going to kind of discuss what an oscillator is. We're going to kind of go over the two camps they fall into, how you can tell by looking at the chart of the oscillator which one it is, and what each camp attempts to do. They do different things and they can be used differently. So we're going to try and go through all of that. Let's see here. We're going to go through a presentation here. You see, we're going to go through what they are. We're going to talk about the two different camps that they fall into. We're going to see how each camp differs and what they attempt to go over. And of course, we're going to go through a whole bunch of examples. So let me just pop over here quickly to a chart. So the oscillator, of course, is just something that goes up and down with some frequency. And we can break those into two camps. One is what we would call a banded oscillator, which means it goes and tends to hit specific areas. And the attempt there is to measure extremes. And within the banded camp, we have bounded, which means that the oscillator goes between two specific ranges, in case, say, 0 to 100, minus 100 to 100, some specific range of items, and it's bounded, and it won't go outside that range. Our second class is center line, and those will oscillate around a center line, and those, instead of showing extremes, are meant to sort of indicate changes in momentum. So we use those to sort of see when things are beginning to shift, whereas our banded ones we see when we've gone to very far ends of the momentum range, where it's extremely overbought, oversold. We're getting like we want to see very far moving examples of momentum. So we've got those two general classes, and what I've got here is a chart, and this just is a Boeing chart, and I've put up, and you can see we've got a lot of them. Obviously we can't go into a lot of detail, and so I'm going to kind of stay high level, and we're going to go over the different camps. We're going to see examples in each camp, and we're going to see how each one of them acts differently and how we would use them. So the first camp up here, we've got what we would call our banded, and these, of course, you can see all have a range. Some of them, like the RSI and the stochastics, happen to be bounded as well. They have a 0 to 100 scale. So RSI is probably the most popular in terms of the banded. I would say stochastics is probably a close second. RSI, relative strength, is basically an attempt to gauge one's own momentum. It's kind of a misnomer because relative strength makes it sound, we talk a lot, Tom, about strength relative to the S&P or to its stocks industry or sector. In the case here, RSI, relative strength, is against itself. It's its own relative strength. If you're interested in this, David Keller just did an excellent blog on RSI and how he uses it. So I invite you to go check that out. That was sometime last week or maybe late the week before. And we've got a range basically here. And we do is we look to see when we hit certain extremes of the range. So we've got our line here at 30 and 70. And those are sort of the accepted values of when we start to hit extreme ranges of our own relative performance. So that means when we're really gaining a lot of momentum, our price is changing quite rapidly relative to what it's been changing in our window here. RSI, we've got a 14-period window. So that's when we can start to really see a lot of big price movements within our 14-day history. And we can see when we get over here, Boeing has had a nice bump on earnings, and it's making a lot of big moves, and that's when we start to see our RSI move up above this range of 70, which is some places, like I know, Tom, you would sort of look to be a little bit wary when we start to change that much. You may want to see a little bit of a pullback. Other people say that this is the sign that momentum is gaining. And simply because we hit one of these extremes doesn't mean that we're going to immediately bounce out of it. We can have momentum that it lasts for some time. You can get into this 70 range and be there quite comfortably for quite a period of time. So it's not sort of as soon as we hit this, we are going to instantly sell, because the probability is we're going to bounce off of this and come back. So we can stay in this range for quite some time. We do bounce off of these, and a lot of times here we sort of stay in the middle, and we're just kind of moving around with not a lot of momentum. Our next one is stochastics. Stochastics attempts to measure within our time period here, say 14, where are we within the range that we've established in that? So the highest high and the lowest low, if we were to plot our current point, where are we within that range? And we keep that as a percentage. So we have a 0 to 100. It's a bounded band. We can see here that there we look at an 80-20. So if we've got if we're in the bottom 20% of our 14-day or 14-month, 14-week period, we don't have a lot of momentum to the upside. We're in the bottom of our doldrums there, our window, and not a lot is happening. If we're up in the upper percentages, the upper 80, 90%, we can see that clearly we're in the top of our range and we've got some upside momentum. We as well, obviously, will pass through 50, but in general, on the stochastics, we don't hang around the middle range. We'll tend to move up to the top and bottom ranges. With a lot of these, all of these bandits, they're better for, I say, they're for predicting extremes. So when you get to the middle range, the momentum has sort of left the building, and they're not quite as effective. Which is essentially saying, in the case of a stochastic, if we hang around the 50 range, it means we're in the middle of our 14-day window in price. So we're not the high, we're not the low. If we stay in that range for quite some time, we've essentially lost momentum. And then in that case, it's probably better to use a slightly different indicator to track what's going on.
Hey, Bill.
Yes?
Yeah, I mean, RSI and stochastic are the two that I generally have on my chart. I always have RSI. Sometimes I have stochastic, and I get the question sometimes, why do I have stochastic on my charts? Because I never talk about it. And for me, when you look at this chart, I mean, this is a good example. The problem I have with stochastic is it moves much faster than some of the, like RSI. So for instance, if we go back on your chart that you're showing there to about, say, September 14th or so, stochastics moves into overbought territory above 80, but that's just the start of the move. If you go up to the price action, the stock the stock is just making a breakout above those prior highs. And if you look at the RSI at that same time, the RSI is barely in the 50s. And so I like to see when they both, the reason I have both of them on my charts is I think one confirms the other in terms of overbought. So if you look at that final move at the beginning of October, right up there at that high, the stochastics has stayed overbought for 2 or 3 weeks at that point, but the RSI finally gets up and goes overbought at the same time. And that is when you start to see more weakness. So for me, and it's just my interpretation, I mean, everybody's welcome to have their own interpretation, but I a lot of times will use RSI as another momentum oscillator tool to confirm what the stochastics is showing me. And again, I think stochastics, the same thing, by the way, happened at the beginning of January. You can see stochastics in the first few days go above 80. And then look at, if you got out when that hit overbought, you'd have missed the last 6 weeks of the move to the upside. Now, granted, RSI is way overbought now as well. But the point for me is that I like to see both of them overbought or oversold before I start to consider the message that's sent. I don't know how you use them, whether you use them similarly or whether you're not at all. But anyhow, I just thought I'd point that out.
Right. And the stochastic, like I say, it represents where you are from the previous range. So in that sense, it sort of breaks it into boxes. You know, you've like I say, we've in this area of September, we're looking here when we've broken out of this range here, of this range, maybe this box here is essentially what this is character. So we are at the top of this box, but as the price moves up, we're continuing to stay in the box as we move along. So that's why this will stay up above here. And it will take a little bit more time for something like an RSI to start to capture that.
Yep.
So,
Yeah,
so
and I think too, just a follow up to what you're saying there, stochastics, you can have a 14-day period. I guess it's actually 3 days average, I guess. So it has to stay there for 3 days. But you can have a 2 or 2.5 week period where a stock doesn't do much at all. But if it just happens to close 3 straight days near the top of the range, it'll look on stochastics like it's very overbought. And I would just maybe point back to the middle of April.
right.
Stochastics goes up to like 90 or into the 90s. And yet when you look at the price action on the chart, it really hasn't done that much, but it just happens to be closing near the high of the previous 14-day range.
Right. It's a little bit faster.
Yes.
It's period and timing. So it's, of course, like a lot of these, you need to use multiple indicators to try and get a broader picture. And but that excellent point. We're going to bounce down now to the CCI, the Commodity Channel Index. This is another one that's banded, but it's not bound. There is some mathematics inside the CCI that tries to put most of the signal within this minus 100 to 100 range, but clearly it can move out of that range, and it's a indicator that tries to catch the distance from like a moving average, so how far the price has moved away from an average. So we can see here as well, it will get into this above 100, below 100. It will typically spend most of its time within that range, but it can bounce out again when we get the extreme moves, these extreme big momentum moves up or down. We'll see the CCI exceed this 100, minus 100 range. And the Arun I threw on, this is probably not as popular. This isn't really as much of a price momentum. It tries to gauge trend more, but it's just another momentum oscillator here that is basically the difference. If you've seen the Arun, there's a red line and a green line, and this is simply the distance between those two lines, and it's bounded between minus 100 and 100. So it as well is a bounded band oscillator example. And now we're going to get down to the second camp, which there are more of, and those would be the center lines. And this, I know, Tom, this is one of your go-tos, and Erin also has her PMO, and they're all examples of center lines. And when they cross, is basically we're trying to figure out if there's been a fundamental change. We're sort of, this is more of a little bit more of a leading attempt to be a leading indicator. And often these are used in concert with prices and looking for divergences. So we're looking to see if these momentum indicators are giving us sort of a leading example of what is to come and is starting to change relative to price action. I know you had talked to Tom that you used to use the MACD and I use the PMO or the PPO, and those are, of course, if you can see the graph here, are the exact same thing, except that the PPO uses it as a percentage. So those tend to make it more equal between stocks since they're all on a percentage basis as opposed to an absolute basis. But you can see chart is exactly the same. And what we'll have here, I know you've talked about center line crossings and say this period here where the moving averages all sort of sit on top of each other is when we start to lose momentum. And we can see it here with the RSI if we go back. This means within its own range, it's meandering over this 50% line here. And it's just kind of by definition lost momentum. And we can see that on other indicators as well. So it proves that our indicators are capturing sort of what we're seeing in the chart. I threw both the PPO and the MACD on here just to go over that example that you had talked about when we were before the show of switching from one to the other. And that the PPO is a little bit more, you can go apples to apples against other stocks to sort of see how things are performing against each other. We got the histograms here showing when we get to our center line plots. So you talk about center line crossings and resetting of momentum. And this is one of those examples where we come up and down. PMO, obviously very similar structure. So we can tell just by looking at the two that it probably also uses similar sets of moving averages and whatnot to get very similar results. Again, we have this sort of dead zone here where we've lost momentum, and we come up with a similar sort of behavior pattern where we've got the breakout. One of the questions I know we had on the show was talking about multicollinearity, and I'm not a statistical expert, so I won't really dive into a lot of it, but the basic idea is that a lot of these indicators use the same underlying processes or the same underlying data, obviously, to come up with a number at the indicator. So what you want to try to avoid is using the same indicator that all the indicators use the same underlying information. So you're basically getting a scenario where you're talking to the choir. All of your indicators are telling you the same thing because all of the indicators are essentially using the same methodology to come up with an answer. So that's when you want to try and avoid, say, having all three of these, the PMO, the PPO, and the PMO, and the MACD, as your sole set of indicators, because it's basically telling you the same thing because they're all derived using a common set of indicators. So you want to kind of mix them up, like we were talking, the oscillators of like the stochastic and the RSI. You want to kind of have a broad set that use different methodologies to give you an idea. So you don't want to just get the same indicators that use the same process and then base your decisions on that. And Tom, at this, did you have any comments on your MACD PPO switch?
Yeah, but before I get into that, there was one question in the room. I'll pass this along to you first, and that is, many of these indicators were created a long time ago, and so the authors, use certain parameters for 14-day for RSI, 12/26/9 for MACD, and so forth. Do you think it's beneficial to stick with those original parameters, or do you think that there's some evidence maybe to use different parameters?
I suppose, the market, fear and greed hasn't changed a lot. I don't know the rationale with some of these time periods. I would suppose if within certain markets, you might say, well, maybe we're moving into a market that's much more volatile. So maybe we want to change these to be a slightly shorter, capture a shorter time period. If you're really looking to be a little bit more nimble, of course, you're going to get more whipsaws. I would imagine that a lot of the original theory still holds. I suppose one thing you could look at is how does high frequency trading. That's something that probably didn't exist as much clearly in the 1970s, maybe when some of these, or 80s, 90s, when some of these were put together. I don't know necessarily how I would tweak some of these to factor that in. What would you say on that? How would you think that's a lot of changes occurred there?
Well, I almost always go with the default. And the reason I go with the default is it just makes sense to me, because if I'm trying to predict what other traders or what other market participants are going to do,
exactly,
looking at the market, if they're all using a default and I'm using something that nobody else is looking at, I don't know how I can predict what's going to happen off of those parameters. You know what I mean?
Right. We all use the 200-day and the 50-day because everybody else does. And now the black boxes are programmed to use those dates. So that sort of becomes the de facto standard.
Right. Right. And so for me, I like to use the default because I think it helps me to predict what other traders are going to do, because most other traders use the default. I can't justify just coming up with it. I mean, I could always, you can pigeonhole things, and I could go back and look at a chart and say, well, it's not really bouncing off the 20-day moving average or the 50-day moving average. But if I insert the 31-day moving average, everything's perfect. Well,
right,
you can always make something fit on that particular chart. But the question is, does it make any sense? Does it make sense that something would bounce off a 31-day moving average? For me, no, because nobody else would be buying off a 31-day moving average. So
right,
that would be my thoughts there. And as far as the MACD and the PPO go, I used the MACD for a long time. I finally made the switch. It was probably 3 years ago, something like that. I mean, I had been using the MACD for many years. And there's really no difference. The difference you pointed out, Bill, is that the PPO, you're taking those two, you're taking a 12 period and a 26 period moving average, and you're taking the difference in terms of percent for the PPO. For the MACD, you're just strictly taking it in terms of dollars. So if you wanted to compare, for instance, the momentum in Sirius XM Holdings, which is $5 stock, $6, whatever it is, and compare it to Amazon, which is $1,600, $1,700 stock, if you use the MACD, well, of course, Amazon is going to have, in terms of dollars, much wider differences between its two moving averages than, say, Sirius XM is going to have. But if you base it on the PPO, which is a percentage difference of the two moving averages, then you should be able to compare momentum on Sirius versus momentum on Amazon.
Right.
The PPO to me just makes more sense. It was just getting out of the habit. I'm very much a routine type of person, and so the MACD was just it for me. I knew the PPO was always better. I just never wanted to make the switch, and I just finally one day got up and made the switch.
Right, and that's what I would say is the main difference is since the PPO is much better for comparing momentum, and doing more apples and apples and make the playing field a little more level so you can do a comparison. If you're looking between two stocks, do I like this one or that one? PPO is probably a little bit more useful in helping that comparison.
Yeah, and the other thing that I found too with the PPO, because it does give you a percentage difference, and again, this is just a personal thing with me and how I use the PPO and the way I used to use the MACD. If you get a stock that is, I'm not going to say parabolic move, but if you get a stock that's really moving rapidly in one direction or the other, you will see the PPO get either above 10% or below 10%. And you're almost always going to see a negative divergence, on an uptrend, negative divergence, or in a downtrend, a positive divergence emerge, because it's very difficult to keep that slope of a price going to keep a PPO at 10%. I mean, it's almost impossible. I mean, there are a few exceptions out there, but for the most part, you're going to see a negative divergence emerge in that kind of a situation. And when I used to do the MACD, I'd have to take the MACD and divide it by the price of the stock to get a sense of have we reached that 10% level. Well, when I use the PPO, I don't have to do any calculations. It tells me when I'm at the 10% level. So there are some other reasons that I think for me anyway, it works better now that I've gotten used to the PPO.
Right. Great. All right. Well, we'll keep going along here. The next one I threw in was slightly different. Is the speaking of our friend Julius and RRG, is the RRG oscillator, and this is relative strength, and it does go against a different stock, unlike the RSI. And in this case, we're looking at Boeing versus the S&P 500 index. And as you would expect, over time, those will have different values of who's outperforming whom. And so we can capture that with Julius's momentum oscillator here. That's just another example. And then you were just talking about percentages and rates of change. So ROC, the rate of change, is probably one of the most basics in terms of rating ourselves. This is just a percentage change over a window. Again, it oscillates between up and above and below zero as to whether it's going up or down. Again, we have this case here where we had our sort of our no man's land. You can see here our rate of change is essentially flat for some period of time, showing that we're not making a big move in any direction. But then we can get over here and we can see this is when our bigger moves in momentum. So if we have an ROC that's basically around this center line, again, sort of a signal that we've kind of lost momentum, and momentum's just, we're kind of drifting sideways. That's another common theme with these center oscillating indicators. Then we got a couple more that are a little bit prettier. They show us here where we've gone up above in our center line, the Chaikin money flow and the DPO. Again, at the purest form, above the line is showing momentum, positive momentum, and below is negative momentum. We can see, of course, here we got changing momentum as we got a downtrend here in the money flow. Also used with divergences, very common scenario for both of those. Then we're going to start to move into a slightly different class, and I'll kind of finish out this group of indicators of indicators. So this is the ultimate oscillator, which if it were really, we would just have talked about this and been done. The ultimate oscillator uses buying pressure and I believe some true range, and then it takes maybe 3 or 4 different time period moving averages, puts that into a formula, and comes up with a number. So it's sort of much more of an indicator of indicators with some hybrid formula behind it, getting a little bit more complex, and using multiple moving averages attempts to sort of smooth out and give different weights to the long-term, medium-term, short-term performances. Again, it looks very similar to the RSI. So in this case, we've got a banded oscillator that's bound 0 to 100, and we have the same areas of extremes. So we've got 70 and 30. So very similar. We tend to spend much more of our time inside this range than we do on the extremes. So that's a little bit different than the RSI. Another indicator that's fairly common that is an indicator of indicators is Martin Pring's known sure thing, the KST. And it takes several moving averages. I think, gosh, it's either this one and or the special K that take, I think, 8 or 9 indicator time periods to really get a broad selection of time periods and then merge all of that into a single indicator. And even that shows still we have got our loss of momentum in this area that we've seen in other indicators. So it behaves, all these oscillators, like say, fall into two camps and they behave differently. They try and track things slightly differently. And these examples here that we're using multi indicators of indicators pieced together in different ways to come up with a single one, but a lot of times they still follow the general behavior. The next one is not really an oscillator as such that we typically think about it, but the scooter does have a 0 to 100 range. In that sense, it is band and bound. It also uses multiple time frames. It uses 6 independent pieces of data, 2 in the long term, 2 in the medium term, 2 in the short term, to come up with a number. And these are based on relative strengths within what we call the universe. And this will be, say, Boeing is going to be in the large caps, and we may have several hundred, or in some cases, in the case of the small caps like the Russell 2000 or the ETFs, or say the TSX, we're going to have hundreds and thousands of stocks that this is being put against in terms of relative performance. We don't have a set limit here, banding, like we would say with the Ultimate or the RSI of a 30-70, or maybe the stochastics of an 80-20. But if you talk to probably our biggest proponent of the scooters, Greg Schnell, he often talks about a 70-30 sort of split. We haven't really specifically marked that, but a lot of times he looks for things that are outperforming 70% of its brethren or underperforming 30. So it's, again, sort of similar. It's a little bit outside, but I thought I'd just throw that in there because its behavior is fairly similar. And our last one that I've got here is, oh, go ahead, Tom.
I was just going to add one thing too on that scooter. And I think the reason, 70 or 75 makes a lot of sense to me, at least to get above that level, is that for those of you, and you can go into the chart school and pull up the article on scooter to get into the calculations, but 60% of that scooter score is based on long-term indicators. So it's weighted very heavily toward long-term performance. So you're not going to get a stock that comes out with good news one day, gets a spike, and all of a sudden shoots up into the 90s on the scooter. Not if it didn't already have a pretty good number to begin with. But 60% of it is based on long-term indicators, which is looking at the percentage of, I think it's below the 200-day EMA. Mm-hmm. And then the other, that's 30%. And the other 30% of the long-term indicators, the 125-day rate of change. And you talked about that rate of change. So you've got to have a pretty good look on your chart relative to all, in the case of Boeing, and relative to all the other large cap stocks out there. You've got to have, there's got to be a lot of movement well above your 200-day EMA, and then also that 125-day rate of change in order to get yourself up into that 75 category. So I think there's something to be said for, trying to stick with stocks that have scooters above 70, 75, because that they have to have a certain element of long-term strength to get there.
And if you're looking for outperformance, I mean, by definition, you've gotten outperformance within that group. You will sometimes see a scooter pop. I know we've gotten question support into the customer support team sometimes of, you'll see a scooter do a huge pop in one direction, but today's change isn't that much. And they'll say, well, what's the difference? And sometimes you have to go back to that 200 days or that 125 days, and you see that there was a huge event that happened, a major gap happened 200 days ago, and suddenly the 200-day average piece has taken that into account, and it's completely dropped off, or it's completely has shown that that big move has finally disappeared 200 days ago that will affect the scooter change now. So sometimes we will get these adjustments months later when we've had a massive change in the price in the past. So you can see what appear to be bizarre reactions on the scooters sometimes, but if you look back at the those time windows going through the chart, you can see sometimes you'll get those.
Good, very good point.
All right, and our last one is the Tushar Chande's trend meter. This is a relatively new addition, maybe in the last couple of years. It's another example of a bounded, banded. It's a 0 to 100. It's very similar in intent to the scooter. It also uses multiple data points to generate its number. I believe from when I was writing this up, it uses standard deviations. It uses Bollinger Bands, position within the Bollinger Bands, and then it takes a number of moving averages, cranks all of that out, and comes up with a number. Like the RSI, and unlike the scooter or the RRG, the CTM is against itself. It's its own momentum indicator, so it's not comparing it relative to anything else. And you can see just by the coloring scheme that there are set bands here. We've got about 5 of them. We've got a 0 to look like 25. Then we've got the middle band. We've got 3 upper bands. And again, I would invite, if you want to go into any of these a little bit more detail, look at Chart School. But obviously, you're talking about the red band it's relatively in its worst session of windows of momentum. And obviously, when you get up into those green bands, you're talking about some momentum is turned around quite a bit. So you can make decisions here on when it enters certain bands. I know even within the scooters, there's a lot of people who would think, well, maybe 30 versus 20. So Tushar has developed this with 3 or 4 different interesting bands that you can take advantage of there and kind of play around with. With any of these, we can change the parameters. Like you talked about the question of, are the parameters exist or the defaults exist? If you want faster action or slower action, you can, of course, change this. With any indicator, faster action means more whipsaws, slower means maybe you missed the move. And it's sort of a bit of art and science there. Going back to your point, Tom, about, picking a 31-day average, this is one of the things I see people do with back testing. They'll keep tweaking a model to make it match the past history perfectly. And then it goes for a few weeks or a month or two into the future, and the model doesn't work and they throw it away. So that's one of the reasons I've sort of not been a huge proponent of back testing, because I think people tweak the models to get it to match what happened, and then the first time it goes horribly wrong, they throw it out.
Yeah.
No.
Yeah, I don't think there's anything wrong with having a system and consistently applying it.
Oh, yes.
But to try to pigeonhole or try to make something, try to come up with something that makes it work in that current environment over a 1-year period, I think can be a mistake when you try to take it forward.
Yes, I mean, absolutely. Doing predictable stuff, consistent is definitely the way to go. It's when I see people try and say, well, if I like you said, well, if I change it to 31.8436, it works all of a sudden magically. Like, yeah, I'm not buying that.
We're not going to go with that. There were a couple more questions in the room before we wrap this segment up, Bill. Mm-hmm. One was, do you have any thoughts about the Williams %R? And because that's obviously a momentum oscillator. We didn't go over that one, but
right. I haven't used that one as much. I can throw that on here. We can take a quick look.
Yeah, I don't use it either, but isn't that like the reverse of the stochastics or something? It's not one that I've ever worked with.
That again looks like it's bounded here. Yeah, I haven't really spent a lot of time working with the Williams. I know a lot of people have used that. It does look like it's got a stochastic type behavior.
Yeah, and it's in minuses. I think if you put it up there next to the stochastic, it might be somewhat similar.
Right.
And it used that 14-day look back period as well.
Just gonna pop a stochastic next to it because it's a little bit faster than that.
Yeah, let's see if they are similar.
It's very similar. Another thing is just sort of a wrap up of this whole thing is that now I'm hoping that you'll be able, if somebody goes to the proverbial cocktail party and shows you an unknown oscillator, you should be able to get some idea of, just based on its behavior, its visuals. Is this banded? Is it bound? Is it a center line? If it's a banded, it's trying to show us extremes. If it's a center line, it's trying to show us changes and maybe used in like I say, in concert with divergences. So just seeing the chart of an oscillator now, you should be able to look at it and get a pretty quick idea of what it's trying to do and what it's trying to accomplish just based on its composition.
Mm-hmm. All right, one final question, and this is a good one. I've got my thoughts, but I want to hear yours first. These indicators work best in volatile markets, right? Question mark. A narrowly traded or trending stock will not work well using them. Is this correct? What do you think?
Well, certainly, like we've seen cases up here, our KST is flat, our rate of change is flat, RSI is flat, and a sideways trending. I mean, if you've got an upward trending or downward trending, then you may get some better signs out of these. But I would certainly say if you've got a sideways, I was trying to find a good example of something that had a flat trend here. Let's see if I can find here. I think Lululemon, let's see, had demonstrated a period where we had some of our momentum oscillators kind of going sideways. This period here, we've got almost an entire quarter where we've basically got a trading range, but also look how small our boxes are. Our candles are very small. So we're going to see a lot of these oscillators sit around. The rate of change almost goes completely flat. Ultimate oscillators almost again completely flat. Scooter is flat, but that's a relative thing, so it's a little bit harder to place that. So if you get something that's trends sideways for a long time, right around these 50 marks, I would say that those are a little bit, these indicators, just show there's not a lot of momentum at that point.
Mm-hmm.
What are you thinking?
Well, when I look at, and I use, again, mostly RSI, occasionally stochastics, but mostly I'm an RSI guy. And so, RSI, in theory, 30 is oversold. And when you get to 70, you're overbought. And I think in a trendless market, when you're just going sideways for a while, I think that relationship holds true. I think when you get into an uptrending market, I don't necessarily look at RSI. I don't look for pullbacks to take the RSI back to 30. A lot of times in a uptrending stock or index, you'll see the RSI pull back into the 40s. And I tend to use 40 as my oversold level when I've got an uptrending stock. And so if I get to a key moving average or I get to a key price support on a pullback and I look down and I see the RSI is at 42, a lot of times that's further confirmation to me that that's a good, solid reward to risk time to get into an uptrending stock. And likewise, when you're in a sideways consolidation, many times you'll see the RSI between 30 and 70, and you might not even get to either one of those levels while it's consolidating. And then you get the breakout and you start trending higher, and you'll get a period of overbought. Like RSI will go above 70 and stay above 70 for a while. Right. And if you don't recognize it being in an uptrend, your first thought is when it hits 70, you want to sell it. But I think sometimes you can be overbought for a period of time, especially in an uptrending stock. So I treat the RSI and stochastics differently based on the type of market I'm in.
Exactly. And this does show it fairly well. I mean, this is over here is even a longer sideways period. And like I say, the RSI is bouncing around, basically around our 50 line. And then we do finally get our breakout and we get our RSI up there. So we've got, like here, our MACD. You can see the histogram makes it really more obvious that the moving averages are essentially flat the entire way. They're going down, but the delta between them is almost negligible for quite a long period until we finally get this breakout that they had in April. And then it's trending, but it's an uptrend. And of course, like you say, then we start to see different behavior in the oscillators. But I think you're right. When we have the trend that's sideways, then I think the oscillators don't do well because there's no momentum. There's not a lot of momentum going on. So as something that measures momentum, it's essentially telling us there's nothing there until we see a change, definitive change in one direction or another.
Right. All right. Well, first of all, thanks. That was a really good lesson, I think, for a lot of folks out there maybe who are, trying to figure out all the different oscillators, because there's so many different indicators here at StockCharts, and they tell us different things, and yet you can group them together. you know, again, like you were saying, Bill, I think if you take 4 indicators that all kind of track the same type of information and you use those as your 4 indicators, they're always going to tell you the same thing. So I think it is good to use, first of all, to understand the indicator that you're using, make sure you understand how it's calculated and why it does what it does. But then finding some other things that corroborate, I think, is important too, rather than just putting together everything that's going to tell you the exact same thing.
Right. And I would say if obviously if people would like to dive into any of these in more detail, you can go up to a chart school. All the formulas are up there, all the logic, some of the history. But this is a fairly high level overview, but if you really want to deep dive, I'd recommend going up there.
All right. Sounds good. Okay, well, let's go ahead and jump into the 10 in 10. I do want to just remind everybody that we do have a poll out there, though, asking which of these momentum oscillators that you use. And we'd love to hear, you know, who uses what, get a sense of, you know, what tools are being used at StockCharts. And we'll go over that poll at the end of the show. All right, let's jump into the 10 in 10. We're going to go through this pretty quickly. First is Generac, GNRC. They did, I believe, raise their guidance today, and that was the reason why we got a nice little pop here. But I did notice that we failed at the overhead resistance, so I've just marked this price resistance that you can see here. So after getting good news, getting all the way up to this prior high, we've turned, and we're now $2.50 off of that earlier high. So I think in the short term, we've got, you know, a few issues here on the stock, but a breakout above 55 is ultimately what we want to see here.
All right, next is Disney.
All right, Disney. Yeah, I wonder how much Netflix is eating into Disney. I mean, Disney's just been struggling a little bit here. We had that nice move off the bottom into early January, and we have just not been able to go any further on Disney. I think the area that we want to watch on Disney is pretty evident in terms of price support and resistance, just looking out over the last month or so. All right, that's not what I wanted. Let's take a look. So the recent low is right down around 109. You can see that's where we reversed off of this downtrend. And then we went up and gapped up to 114 and then failed. So I think in the short term, this is a key area that I would watch. Overall, we've got primarily an uptrend in place. So I'm expecting Disney to make a breakout over 114. I do like the reversal that we had yesterday and the continuation today. But let's get a close over 114. I think that would be the sign that things are beginning to improve technically for Walt Disney.
All right, Roku.
Yeah, Roku really started to hit the gas pedal there for a while. Actually, still doing nicely, moving up through 50, getting above gap resistance, and that's the next area. Actually, next 2 areas on Roku, in my opinion. We've got the bottom of gap resistance that we're trying to get through now. You can see what happened the first time we tested it. We failed. We came back down. That's what I would have expected. But now we're going back up and trying to break out. If we get through, I think it could be a fairly quick trip up to the top of gap resistance to fill that gap up at about $58 or $59. So market continues to trade pretty strong. I think Roku, you can see it hasn't even technically had a 20-day test on this move back to the upside and some great volume coming in. So I think Roku looks pretty good here. I just think it's overbought. As far as its relative strength, you can see it's in that computer hardware space. And on a relative basis right now, we're at about a 4-month high. So that's a good thing. The overall group, though, over the past couple of weeks has been struggling against the S&P, and it's not far from where it was before. So the good news is I think Roku is performing well. The bad news is it's a part of a group that is still struggling a little bit versus the S&P 500. I like the stock, but I'd like it a lot more if the overall group began to run.
All right, symbol ACB.TO.
ACB.TO. Oh, it's probably, yeah, it's not going to give me the relative stuff. So let's go ahead and just look at it on the absolute chart. 10.5 to 11 looks to me like a pretty key area on the chart, and that's where we're struggling right now. So let's see if we can get through, maybe even a little above 11. That's the top of gap resistance. And then you can see these reaction highs. We haven't been able to open or close above, say, 1075. And if we do, we got to get through this gap resistance. Look at the volume over here on the gap to the downside. So I think overhead resistance coming in between 1075 and 1150. To the downside, we haven't had a close below the 20-day. I'd probably draw one more line in there where we opened here. I think I'd want to make sure I continue to hold $9 to the downside. If we do, then I would be looking for a test up here in that overhead gap resistance zone.
All right. Up next, Twilio.
Yeah, this has been one of the best stocks in the market until its earnings, and it took a pretty big hit yesterday on some good volume. So far, though, I think it's holding the key level around 105. And this is just a short-term level. Longer term, we could probably find some other levels. But here was the breakout on increasing volume at the end of January. We had moved up, sideways consolidated between about 100, 105 for about 2 weeks, finally made the breakout, and now we've pulled back with earnings to test the 20-day. Actually, we're a little bit below it, but now with today's move back, we're slightly above the 20-day. I'll give it a little bit of room here below the 20-day. Let's take it down to this 105 level. If that fails, then I think it could open up some additional selling in the short term. I still think long term, this is one of the better software stocks out there. Their earnings weren't bad. They did match estimates on the bottom line. They beat on the top line. I think I'm trying to remember. I think they raised guidance, but I'd have to go back and take a look. But they did miss, or they did just match on the bottom line. And I think that was a little disheartening to folks who've been bidding these shares up, anticipating another beat. But Twilio overall, I think, still looks pretty good.
All right, symbol FNKO.
Funko. Yeah, this one was on fire for quite some time, probably up until about 6 months ago. I haven't looked at it in a while. Yeah, when it was actually, it was probably about 5 or 6 months ago. Huge move up, then started selling off for a while. I'm going to bring this one up on the relative chart just to see if it's starting to show any relative strength, because I know it fell apart. Yeah, see, here was a beautiful move relative to its peers in the clothing and accessories area. And then it kind of went sideways, and it still hasn't made a breakout. I'll tell you, this is a thing I would watch on this stock. I would look for a relative breakout above that reaction right there, right here. So we were leading, kind of fell apart. It tried to rally back, and you can see 3 different attempts on a relative basis to break out. Couldn't do it, went to new lows. I would probably stick on the sidelines. I'd go with something else in the space until I see FNKO take out this relative resistance line.
All right, MOMO.
Momo. One of my favorite ticker symbols. Gotta like a stock, got some Momo. Unfortunately, this one doesn't have enough Momo for me. This is in software. Now, first of all, I could just look at this chart and just tell you you've got a bad relative performer, because most software stocks are breaking out or on the verge of it. We're nowhere near where we were earlier back in 2018. So on a relative basis, look at what you got. One of the worst software stocks. I don't like it. I also don't like the failure at gap resistance that we saw right here. So here was your gap down on big volume, worked our way all the way up. Look at that false breakdown. Anytime I get an intraday move through a key resistance level, I assume technical buyers are going to be out there. It's going to continue. We're getting a breakout. When you get that false move, it makes me much more nervous. I would just say this: if we fail to hold 28 and a quarter to the downside, I would be really careful with it, because it's not a favored stock within software. And if it can't hold the rising 20-day moving average or these recent lows, I would be out of it.
All right,
Shopify, they just reported, and I think the numbers were pretty good there. I've looked at so many earnings reports, hard to remember them all. But they did just report yesterday, I believe, or maybe it was the night before. But Shopify, gap down. I think I remember talking about this one either, I think it was during the show, and I liked the fact that it was pulling back, hitting that rising 20-day moving average. I think we're going to get a breakout, because this one you can see, we just talked about Momo and how weak it was on a relative basis. Look at Shopify here. Double top, breakout. So we're moving to new highs, even though the software group has not moved to new highs. And so when you take a look at the relative strength, this is a stock that has been getting its fair share of money within the space, which I like. So I like the 20-day test. I think eventually we're going to make this breakout above the recent highs. So what I like about the stock is the potential breakout, but it's also the fact that software has been going up. This stock on a relative basis has been very strong for the last 3 or 4 months, not only versus its peers, but also the S&P. And you can see the overall group continues to strengthen here as well. So I like the stock. I think we're going to get that breakout over 180 in the near term.
All right, next up, Tencent, TME.
All right. TME. All right, well, not a lot to show there. Let's actually go back to a shorter chart. I think it'll show up a little bit better. I don't usually trade stocks that don't have a long history because I'm trying to study the history of price action to predict what's going on. And clearly, we don't have a whole lot of history here. So the only thing I could say is that we got a nice uptrend here. Volume picked up, pulled back, essentially held the 20-day. We failed one day, came right back up above it, which I like. And now we're getting another breakout above 16 and a quarter. So short term, what I would look for is support at about 16 and a quarter. That was prior highs. We've taken that out today. Now, if we lose that, if we leave a tail up there, intraday move, this is, again, like I was just talking about earlier, I would expect technical buyers to jump in here. We're breaking out. So if it fails, it's telling me maybe in the short term, market makers are jumping back on the short side. Maybe they've got a client that's looking to sell, and they're selling into this strength if you get a reversal. So that's why I get concerned with reversals. But I would keep watching this rising 20-day moving average. I think a test of that would be a pretty good buy signal.
All right, last up, symbol MTOR.
Yeah, I actually own this one, and I haven't looked at it in a while. Okay, it's up. Good. Yeah, I was afraid to pull it up. Never know what's going on in the market. But I like this one because it pulled back and hit price support and the 20-day moving average. And that's how I like to trade. I like to combine different aspects of technical analysis. So here was prior resistance. We pulled back, hit the 20-day, and that was earnings related. We gapped up, came back, tested that area. And when we came back down and tested it again, I was at support. I had tested the 20-day, and I think I waited on this one actually for it to come back up above 20. So I think I got it a little bit above 20. Short term, I think you've got overhead resistance at about $21.50 to $22. That's where I would be looking for. If we get up to 22, depending on the volume, I'll probably take profits and move to the sideline, see if we can get through. But I like the stock. I think it looks pretty good here. Another example maybe of how you get overbought, pull back a little bit, and then we start to go right back up again. I think MTOR likely makes the breakout over 22, although I'll be reevaluating if we get up there. And I think that is it. That was the 10 stocks. So probably a little over 10. Well, maybe it was about 10 minutes. I know we started a little late. But there you have the overall recap of the stocks I just went through. Tried to annotate them as quickly as possible. Really the idea here, and I know, part of it is doing a review of these stocks that are given to me. But really, it's to show you how quickly you can annotate and save these charts in a chart list. Really powerful. Now I can go back. I could look at key support levels I identified. And it also is a way of not forgetting. Because I don't know about you, Bill, but I know many times where I say, man, if this stock were to get back to this level, I would really be interested. And then I look at it, 3 weeks later, and not only did it hit the level, but now it's up 13 or 15%, and I didn't get in.
Right.
So always good to keep a chart list and, good reminder.
And an alert.
And an alert. Yes, good point. You can set alerts.
Alert, man.
Yep, use those alerts for sure. Okay, let's get a quick update on the market, and then we'll get into our final segment, which is a new segment. So I will try to speed through this update for you. And let's see what is going on. All right, well, we got the Dow Jones Industrial Average currently down 43. I think it was down 105 when we started the show, so more improvement in the market. The S&P, which I think was down 6 or 7 points, is only down 1. The NASDAQ now has broken back out to the positive side, up 21. Russell 2000 up 5.5. 10-year Treasury yield still down 2.66%, down about 5 basis points today. Volatility index continues to decline. That's bullish for the market. Communication services, energy continue to lead the way to the upside. Financial struggling still with the 10-year Treasury yield down. And there were 3 individual stocks that going in different directions. Marathon Oil, of course, in the energy space, breaking out, which is bullish. Cisco, even though it's off its earlier high, I really like that chart. We talked about that one earlier. And then International Flavors. Market doesn't like missing estimates and lowering guidance. And I think that's pretty evident with IFF today. All right. I don't know, Bill, before we get into the final segment, what do you think about the yield not really rallying. I mean, I would expect money rotating out of treasuries to support this stock market move, and that should be sending the yields higher, and they're not going higher. Do you have any thoughts on the treasury yield?
I had the same sort of idea. Like I would have thought, and it was another case when everything went down. You'd expect obviously in the December that everything would be moving out of equities into treasuries and bonds, bond funds and preferreds and all those sorts of instruments. And you didn't really see that, and so I'm kind of perplexed myself. I don't know quite where that money going. And I mean, I sat on a big chunk of cash because I didn't know what to do. So maybe there's people like me out there that are just kind of looked at that and were dumbfounded and just kind of ran to cash and just sat there for a while.
Mm-hmm. Yeah, well, I was there for a while too. I sat in cash for quite a while, and actually, I was even worse because I kept trying to short the market on the way up. The good news is I was keeping very tight stops, but I was definitely trying to find key levels because I've done a study of the history of the market, and even cyclical bear markets, even if you're bullish the overall market and you believe that it's just a cyclical bear that was quickly going to move back into a secular bull, the last two of those that we had, 1998, 1990, both had at least double bottoms, at least got a retest. Mm-hmm. And this one just had a V bottom, and maybe it still goes down. I mean, there's probably many in the camp, probably many listening to the show still think we're going back down. I don't think we're going to. I really don't.
Yeah, it's when I was on whatever it was, maybe it was in December, we were talking about I think this topic that was going short and ways you could look to find things to go short. And that's what at the time I remember mentioning that it was so tricky that I didn't really buy a lot of like the big inverse juiced ETFs because a lot of the time now I find it's a V bottom, and if you don't get that, if you miss it, it's gone, and it turns on you very, very quickly. And so that's why I had started to just not try and play that game, because I know that I don't have a lot of time to look at the market, so I could easily find myself going, oh wow, that has just really gapped on me, and I was completely unaware of it. And you would really like to see a long extended bottom to have the time, but these V recoveries are more frequent now.
Yep. All right, well, we are going to move into chart chatter, our final segment. And the first stock, and Bill, you and I were talking about this one before the show, Sierra Wireless. I have it up on the screen here. And this is a stock. I'm going to just give you a quick synopsis what happened here. So the company missed their revenues and their earnings per share. So top line and bottom line misses. Couldn't match or couldn't exceed what Wall Street was looking for. And then they went out and guided quarter one revenues and earnings per share lower, and guided fiscal year 19 revenues and earnings per share lower. So this was like the superfecta of bearishness for Sierra Wireless. And the reason I bring it up, when we follow technical analysis is we're using it to kind of predict what's happening. We're using it to read the market, read things into the market that we don't yet know. And so when I look at a stock like this, and feel free to share any charts that you want to, Bill, but I've got this up on a relative chart so we can take a look at what the stock was doing in the fourth quarter. Now, of course, the overall market went down. Telecommunication stocks, you can see, went down. But on a relative basis, this stock topped back here in September, and it was going down faster than its peers, faster than the S&P 500. And even though the overall group was still doing pretty well, look at what Sierra Wireless was doing even before today, even before this big drop. And so to me, when I look at this, the chart chatter is that we should have been expecting a not so good report, that there was something going on with Sierra Wireless before we got the news and the big drop to the downside. Do you agree with that?
Yeah, before I was looking at this before the market, so I didn't see that last bar, which of course changes this story quite a bit. And I was just kind of looking at that period of November to up until yesterday, essentially. And I was trying to kind of look at it and think, well, if I had my Wyckoff glasses on, it fits the beginning part of a Wyckoff pattern with a climax sell. You've got a just huge dump there, and then it sort of bounces back. And I was saying, if I was going to look at a Wyckoff, I'd think, well, I would expect to see a secondary test of that 13 level to sort of shake out any additional weak hands. It may test that 2 or 3 times, kind of go in a trading range and then bounce back up. And then I I checked it at like 6:32 a.m. our time, and like, oh well, I guess we got our drop, but that's not quite the ordered way that you'd expect a Wyckoff process to work. So we've kind of really dropped there. And the other thing I threw on was a volume by price overlay to see exactly. There was a huge amount of volume traded at that initial gap in November. So you can see there, and that is going to be a significant overhead. Even as we were prior to today, we were kind of almost back up to that resistance level. And so, but I was thinking that amount of volume there is really going to be represent a lot of overhead. So to struggle to get through that gap was going to take some time, I would have thought. But then today's announcement, of course, completely changes the picture.
Yeah, now we've got to break down to that prior low. So now you got another major level to try to
start it all over again.
Yep.
Essentially, if you look at the charts, it's like we have little islands of quarterly gaps, and this is beginning our third.
Yep. Well, and the thing is, this I'm sure was earnings related and went up. And I always get questions where, if I have a company that's reported strong earnings, get a nice positive gap up, and I'm looking, for entry into it on a pullback, like right here, when I see a gap up in that long tail, that's where the buyers came in that day. And right. So if you get back down into this area, typically that's where I would tend to buy Sierra Wireless. And I remember being very bullish, and I'm sure back in September, if I went back and replayed MarketWatchers live shows, this is probably a stock that came up that I was very bullish about. And a question I get sometimes is, well, why don't you just hold a stock like that and wait for the next earnings report? Well, you can see what happens at the next earnings report. Many companies, most companies are not Apple and Amazon, where they're conservative with their guidance. They typically are growing. They're beating estimates. They're constantly improving on their charts. Many companies do exactly what Sierra Wireless does, where they outperform their competition for a quarter or two, and then something else better comes along, and all of a sudden their products aren't as great, and they have to try and reinvent themselves. And so that's the main reason why I'm not a buy and holder. I don't like to hold stocks long periods of time, because it is hard to find the Apples and the Amazons and the Netflixes of the world when they're smaller companies.
Well, even if you look at that, after it came down and hit that support, and then it made its move up. But then when we got that high tail up there, you look at, we've got like almost maybe 20 days of selling with a couple of little breathers in there to come back. And then that's when we finally kind of get back down to that gap support and ultimately sort of lose it. But even that's sort of giving you a signal that there's not a lot of confidence there in the market.
Yep. Well, I am pretty sure I was among the losers in here somewhere.
That was you, huh?
Well, I just remember, because I was a big fan of small caps back in September. September was probably my worst month. I did much worse in September than I did October through December. December didn't bother me at all, because when we topped, I was actually moving to the sidelines. So that didn't bother me. But I had a really bad September because I was playing small caps because the dollar had been so strong. And I thought small caps were the play. So I had a number of small caps get stopped out back to back to back to back. I mean, it was like, I don't even remember how many, but it was a bunch of them. September was not a good month. I'm not even looking back at September anymore.
You've repressed it already.
If we could get Chip just to take September off the chart, that would be preferable for me.
All right.
All right. Well, I know we spent a lot on that particular chart, but let's do one more. I'm going to do one that actually reported some really good news, and tell me if you see anything with this one. And I'll leave the volume by price up there. NGVT, another small company. Wow, the volume bars are all over the place here. But here was a gap up. This company actually beat on top and bottom line, and they guided fiscal year 19 revenues and earnings per share higher. So this is the flip side of it, and now we're gapping up above these prior highs. Anything strike you on this chart as you look at it?
I mean, there's a lot of volume increase over that last previous quarter there, where we came down and tested the low in November. We're starting to see a lot of volume. Mm-hmm. And of course, we got the December 24th. But it bounced pretty quick. We had that rout on December 24th, and it looks like it's come back pretty quickly and regained its 20. And like I say, it's outperforming its sector and industry.
Yeah, I would say, and that's probably the key for me, is that it is outperforming its industry group. And this is the specialty chemicals area, so it's in materials. But here, even before this move to the upside, you can see that it was near the high relative to its peers. So it was already getting its fair share of money that was going into the specialty chemicals index area. So that's a little bit of a clue that they've got some pretty good stuff going on. And then we get the news, we get the breakout, and you can see the volume clearly coming into the stock now and after sideways consolidation for a while. So I do like the look of this chart, although I don't like to chase a stock that's up 13%. I like to let it settle down, let it move up a little bit more even, and then pull back and maybe head back toward this 106.5, 107 area. And then some point down the road, it could be a nice trade. This is one that I would put in my strong earnings chart list and just tuck it away and wait for a better opportunity.
Yeah, it's popped nicely above that overhead resistance that's been going on since way back to August at about whatever that maybe 102, 104 range.
Yep. So anyway, so that's chart chatter. Just a couple of stocks that we looked at today. Maybe we'll do another one sometime. I have a little bit more time and get into it. But I do think that these charts tell us something if we're listening. If we know how to read the charts and understand, and it's not just about whether it's going up or down, but it's also about how it's doing relative to its peers, what the market's doing, what's going on in the bond market. I mean, there's all kinds of things. It's a real puzzle that we put together each and every day based on technical analysis. So, and again, I would always point this out. To me, technical analysis is not about trying to provide a guarantee about being right or wrong. It's about managing risk, and keep that in mind. All right, I want to pull up this poll because I want to know what everybody uses in terms of momentum oscillators. And I'm sure after your presentation, you want to know as well. But there you go, Bill.
Wow, yeah, RSI is a very, very common one. I would have thought maybe MACD would have been a little bit higher, but obviously the PPO people have maybe like you taken to the advantage in terms of comparing.
Mm-hmm. Yeah, I don't know how I would have. I think I would have guessed RSI to be number one. I'm a little surprised PPO is above MACD.
That was my comment too. It's pretty close, but I was surprised that just because MACD is just. Oh, there he goes.
Did you just click on it?
Somebody out there helped us. Click a couple more times. We'll get this the way we want it. We'll back test this properly. But yes.
Yeah. Speaking of pigeonhole, and we're going to go ahead and pigeonhole, right?
Yes, our producer is over there madly clicking some button.
Yeah, I'm a little surprised. Rate of change is only 11%. I mean, I've actually started to use it a little bit more.
Mm-hmm.
I haven't incorporated it into my default chart style, but I do use it a little bit more. I think where I've used it, and I tell you what, I'll pull up a chart and I'll show you how I use it. But you got to give me a minute to pull it up here.
And the rate of change is fairly, in terms of indicators, one of the more simplistic. It's very basic. It's purely just 2 data points, and there's not a lot of moving averages and formulas to try and bound it within a range. So it's fairly pure.
Yeah, I'm going against the clock here. I don't have a whole lot of time, but I'm trying to get it. Okay, let's take a look at this. All right, so this is a chart of the jobs, non-farm payrolls. And so here's non-farm payrolls, and down here below, I've got the rate of change. Now, before we went into the bear markets, we had jobs drop, and you can see the rate of change went negative both these times. Notice now what's going on. We actually have the rate of change rising with these jobs reports. So those who are thinking that this is a bear market, I just want to point out maybe not so much. You might want to think about that in terms of the rate of change, the fact that jobs are actually being created faster and so forth as we move on. Anyway, I thought that was interesting. But Bill, we got to wrap up, but I do want to thank you for joining me today. I appreciate it.
It's great fun to do this again.
Yeah, it's always fun having you on the show. Really appreciate it. I want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everyone. We'll see you back here tomorrow. Happy Valentine's Day and happy trading.